Good afternoon, and welcome to this web conference with Movinn in relation to the company's end year report for 2022. The company is today represented by CEO Patrick Blok. My name is Johan Larsson, and I work as an analyst here at Västra Hamnen Corporate Finance, and I will be the moderator for today. We will start this conference with a presentation from Patrick, after which we will have a short Q&A session where I will ask questions and Patrick will answer. And to you listening, you can ask your questions either during the presentation or during the Q&A session, and I will ask them to Patrick. Before I hand over the word to you, Patrick, I remind everyone that this session is being recorded, and the recording will be available on Västra Hamnen's YouTube page and Movinn's homepage. So with that said, I give the word to you, Patrick.
Thank you, Johan, and thank you for hosting this webinar. As always, it is appreciated. My name is Patrick. I'm the CEO of Movinn. Been with the company since we founded it, and is spearheading the general development and executing on the strategy we've kind of set out to implement. So 2022 has been a hectic year. It was our first year as a listed company, and we started out the year eager to prove that we could deliver on these growth targets that we set out to do. We have grown the revenue at 30% on group level, which again is fairly substantial. It's in the high end of our guidance. We've added 142 new units across the portfolio, which is above expectations. And we've launched 2 new international markets, basically. So we have been fairly busy. We are also preparing for a launch in Germany. Germany is obviously the most important market in mainland Europe, so that has a lot of focus on my part. We've been doing a lot of the introductory exercises, getting the legal subsidiaries set up, getting all the advice needed to be ready for a commercial launch. We are in talks with some different prospective cases we can use for a commercial launch, but nothing is complete or certain yet. So it remains a bit unsure on when this will materialize. But in general, we set out to deliver on a fairly steep growth journey, and we've added a lot of units. The downside is that it has been tearing a bit on our bottom line margins in general. We have realized an EBITDA in Denmark of 9 million, which is a substantial improvement from 2021, where we did 6. But it is a bit below our guided targets, and that's because we have been caught in a combination of inflationary pressure, rising costs in general, but also the steep incremental growth has been tearing on the organization and on the margins as well. But again, we're showing good progress, not as much as we had liked, but we are learning as we go. So one of the major themes is obviously the international launches and founding the subsidiaries, which is simple enough, but also getting everything put into operations. It has taken a lot of focus, but we've proved that we are able to do this both domestically and at home. So I think it's an important nod to our general kind of proof of concept, and I think it's an important nod to our long-term potential as well. So if you look at these trends or pillars we've put in, you can see that the general development is positive. We've grown the revenue substantially since 2018. We've grown EBITDA substantially since 2018. And we've grown the unit portfolio fairly substantial again, which is which is one of the important value drivers. And this is why these three numbers are kind of put together in this slide, is because the unit growth is obviously one of the important value drivers for our kind of long-term underlying growth measured in like financial performance. So that's why they are in the same slide here. But all in all, the trends are moving along nicely. That being said, of course, we are not satisfied completely with the development because we hope to do more. So we are taking some measures in general to improve on this going forward. The current group structure is as shown here. We have the Swedish subsidiary in place with commercial activity, with a local organization now in place. We have a very good local managing director who is managing all things happening in Sweden. She has an extended experience from our industry, so she in the corporate housing market in general. She's been working for one of the largest relocation agencies in Scandinavia in a senior management position. So we were lucky enough to snatch her and get her to operate our Swedish entity, which is great. The German company is founded and kind of ready for a launch, but there's no activity there yet. And then we obviously have the Danish parent and the Danish subsidiary besides that. If you look at our performance, you can see that our revenue has grown from 56.2 million to 73.3, which is a 30% change on group level. So that's approved. It's in the high end of our guidance. As I mentioned earlier on, the downside has been that we've not been able to stay as profitable as we had hoped. Our operations in Denmark are showing up a retained earnings in a positive retained earnings in the level of 700,000 Danish. But we've had some one-off costs and obviously also an operational cash burn from launching in Sweden, which takes the total earnings in the negative. But again, we have the Danish foundation, which is fairly strong, and then on the top of that, we can build subsidiaries. It'll come at a cost, at a transient cost, but it is kind of a calculated risk. So in general, approved on the top line, but we're a bit unhappy with the bottom line metrics. Again, it has proved a bit tricky to do both in one go, but we are improving as we go, I would say. Our balance sheet remains fairly unchanged. If you look at all the ratios and important metrics, you can also see that our cash flow. You can see the cash flow breakdown in the slide, in the table below. We're doing it on a consolidated level, so you can see that we have cash flow from operations, which is positive. The cash flow from operations has been affected by the operational loss we've taken in Sweden and in Germany. In Sweden, we had the one-off costs to advisors in general, and an operational loss. Besides that, in Germany, we've had one-off finance, kind of advice to, cost to advisors. We've initiated negotiations on different lease agreements. We've secured the rights of our trademark in Germany, which is obviously super important. But those kind of costs has been taken directly on the P&L, and that is affecting the operational cash flow. But it is positive with a 4.2 million, and then obviously we've had a lot of investment activity. Adding the 142 new units is not free, and it is way more than we set out to do going into the year. So we are kind of ahead of the curve on that, but it represents investments, and that can't be helped in the short run. The key ratios is shown in this chart because there's no operational activity in Germany. There's no key ratios, but we have shown it segmented, and we'll show it segmented going forward as well, so everybody can keep tabs on what's happening. You see on an EBITDA level, you see improvements on the Danish entity from last year. Keep in mind that in 2021 there was no international subsidiaries to kind of tear on the overall picture, but there is improvements from 21 to 22 if you measure it in Denmark alone. If you factor in the subsidiaries, it takes the total EBITDA down. But in general, it is kind of a calculated risk, I would say, and it is fairly as expected. But improvement in some metrics and deterioration on some other metrics, which is a direct kind of consequence of the steep growth. Operational data, also something we report on ongoingly and transparently. Again, you can see that the unit number has changed fairly substantially. We've gone from 298 units in the early 2022 to 440 units end of year. So that's a 142 unit change. It is a 47.6% growth year on year, which is again something we've never done. It's been pretty busy. The downside is that it's tearing a bit on the bottom line performance. So you can see the revenue per unit is going down, and you can also see that the vacancy rates is a bit higher than what we normally like to see. But that is a direct consequence of the steep growth. If I have to, if you look at the revenue per unit in Sweden, it says 20K. It is not the number is a bit kind of, keep in mind that units come in throughout the year. There's no full year effect on the units yet, and you don't and also having a lot of vacancy initially before you get the market knowledge and all that stuff will have a negative impact on the revenue per unit. So next year coming into 2023, we will see the full year effect, and we see this metric clear itself up again, so to say, or correct itself. When we did the IPO and when we pitched the initial kind of growth plan and strategy, we estimated that it would cost us approximately 5 million to enter a new market. So to show you the different kind of cost breakdowns, we've made this fairly transparent breakdown of what we've spent on the different items. And the positives is our FF&E investments is lower than we're used to, which is good. We don't have any direct investment in cash securities. We've been successfully negotiating some guarantee structures instead of spending cash on securities, which is a massive improvement on what we've been used to. Then we have the EBITDA from operations, which is a direct operational loss, obviously. We've had the other operating costs, which is a one-off cost to legal advisors. And then we have some allocations from the Danish parent, setting up everything. The Danish parent has been operating Sweden up until October. So we've kind of tried to show the different items as transparently as possible. And you can see that the total investment comes to 4.3. So we're a bit better than we expected to do. So that's good. I'll come back to this in the guidance section, but we expect Sweden to be very close to the break-even point on operations for 2023. So that is also would be a fairly good achievement. And coming to that, here we have our guidance slide for 2023. We are handicapping our expectations a bit, I would say, because of the general macroeconomic environment. We monitor this carefully. Obviously, we still have an inflationary pressure that is a bit higher than we're used to, and rising interest rates. We still have a war going on. There's some unease in the finance industry right now. So all these factors make us be a bit less aggressive, I would say, on our expectations and on our growth to the year. That being said, we still expect to do a reasonable growth rate on group level. Yeah, we guide on 83.5 to 88 million in total revenue. 3.5 to 5 million of those will be in Sweden, and the remainder in Denmark. So it's a 14 to 20% increase from 2022. So that is the current guidance point that we are prepared to offer. On EBITDA level, you can see that the Danish operations is expected to deliver 11 to 12 million. The Swedish is expected to do close to break even, so from -1 to 0, and that will take the total group up to 10 to 12. And then going down, you know, it trickles down obviously on EBIT level as well. And then more interestingly, I would say that we expect to keep our investments a bit closer to the chest. That's again, it's a direct what can you call it, consequence of you know, the current macroeconomic environment. We are kind of playing the waiting game. You could also call it going into cruise mode, and the macroeconomic setting is kind of one explanation. The other is that because in 2022 we almost doubled the number of units that we set out to do. So you could say in principle that we have completed 2 years growth in 1 year, more or less, not completely, but close. And being in that situation, we are allowing ourselves to kind of focus more on profitability, focus more on efficiency, while still planning for long-term growth. And that's why the expectations to the pipeline is also lowered throughout the year, in a consequence to that. In Germany, we are in talk, as I mentioned, we're in talk on some interesting projects, but the lead times are a bit longer than what we used to. I'll come back to the rationale behind that in a minute, but as it is right now, we do not expect a commercial launch in Germany in 2023, but let's see how the years progress. The current product portfolio is the same as we've reported a couple of times now. We have service departments, the corporate departments, which is still the core and product, and the product group that is delivering the highest revenue share. Then we have the co-living sub-product, which is a good kind of supplement to our core business, and there's a very high level of synergy effects between the two. And you can see that the co-living segment has been growing at a pace, at a fairly steep pace. The growth year on year has been at 145% in that segment, so it's been growing faster than the core business. And the core business has been growing 26.5% in the year, and the combined total is then 30. The furniture rental product is something we've postponed the commercial launch a bit. After the year ended, we have actually got it up and running, but we didn't get it up and running in 2022. Again, you know, we had a lot to do on our core business, and we didn't feel like it was the right time to throw ourselves into doing new stuff, since the year was so relatively busy. But in general, good growth on the two launched and existing products, and co-living is growing faster than our core business. The client concentration, we also show this. It's a way for our listeners and shareholders to understand the risk that we are kind of taking when operating as we do. We are a big B2B company. We have a lot of big corporations using us on an ongoing basis. So if we have few clients that become too big, we could be exposed to if they for some reason leave us, we could be exposed towards having a higher concentration on clients. We remain, I would say that the main theme here is that we are still very well diversified. However, we can see that we have a higher concentration of clients in top 10 and top 20 than we had 1 year ago. It's strategically, it's as long as the share remains in these numbers per client, it's still good, because it shows that we can grow with our existing business and our existing client relationships. It also shows that there is a lot of loyalty among the big clients. The biggest one still being a Danish C25 company. So there's goods and bads to this. We don't want the concentration to be too big, but as long as it remains in the low single digits, it also displays some customer loyalty. Technology is a big thing for us. We are not good enough. We are probably not good enough to tell this story, so that's why I keep having this slide on the presentation. But we do a lot of technology development. We do it in-house. We have a great team of people. I'm also kind of part of that development, doing fantastic, software products, IoT products, constantly improving on our platforms, getting the visibility up and our general reach, especially when going to be just a Danish company with local contacts, and then transitioning into being an international company with ambitions across Europe. You need a very strong technological infrastructure, and you need to be constantly kind of looking on the strategic angles on how to be more visible, how to be more relevant among the big clients, because as you grow internationally, the larger clients will they demand more of you, and they demand a lot of the processes just have to be super smooth. But we continue to improve, and we have some good stuff here. And as I've said, as I've listed in the last line of the slide, we are looking at ways to see if we can commercialize our existing IT in different ways. It's not ready for it yet, but it is on our midterm roadmap, I would say. Maybe opening up the platform to third parties, or licensing of our software, stuff like that. That's a focus point for us as like a product. Improving on ROIC, this slide is also has been with us for some time now, and it is extremely important that we keep talking about this, because one of our major investment items is FF&E, as you call it in industry lingo. It means furniture, fixtures, and equipment. Having this plug and play product, you need a lot of furniture and a lot of good stuff, and the ability to source furniture at a good quality at attractive price points is a massive and important exercise if you want to balance your operational performance with your returns. And one of the ways that we kind of solve this riddle is to develop an in-house furniture brand, so to say. So in-house designs, getting the stuff produced directly at factories, buying bulks from factories. It's a way for us to keep prices down, but still have a super high quality. So using products like marble and welded steel, good quality aniline leather, high end design in general. You can achieve this in two ways. You can buy it expensively off the market, or you can try to create it in-house. So this is a stroke of genius, to be fair, and everybody that is doing what we're doing should consider doing the same. The current markets we are in, no secret, we did Malmö and Lund in 2022, taking our total presence up to 5. So a great achievement for us. Malmö and Lund is the most important markets in the southern region of Sweden. It's no coincidence that we chose the southern region of Sweden because of the obvious synergy effects that are between the countries. The Danish operations can support the Swedish one if there's any need for any urgent assistance. And other than that, we have the local team as well in place. The local team is sitting in Stockholm. The head office has been moved to Stockholm, and that's no coincidence either. We are obviously working on launching in the Stockholm region, as it is without a doubt the most important region in Sweden. No offense intended in Skåne, but that's the current market reach, the current unit numbers, and the current pipeline. And again, right now the pipeline looks a bit thin, but that is on purpose. It's not that we're not working on different cases. It's just that we don't have anything kind of signed and finalized yet. So when we do, we will communicate it. And before that, we are being conservative. The next markets we're looking at is, as mentioned, Stockholm for sure, important one. Göteborg as well is super important in the Sweden if we stay in Sweden. And then as I mentioned earlier, Germany is by far the most important mainland market in Europe. So that is our next area of focus. Again, looking at the map, you can see that the dots are close to home, and that's, again, it's a way to, if you grow close to home, you know, it's easier to manage, it's easier to do any kind of disaster relief or whatever we should call it if problems arise. So it's a way to
there we go. Yeah, I think I was mentioning that Germany is being the important market for us, and the next area of focus. And Hamburg is in Hamburg we have some different prospective cases that we're working on. It's an extremely strong market for us. The corporate housing market at Hamburg is very strong. It's the second largest city in Germany. It has so much business activity, and I would say that Hamburg alone has the potential to just be way greater than Denmark. And then you can take Hamburg and you can copy paste that into Berlin, into Frankfurt, into Munich, into these mega markets that you have in Germany. So that's why this is a massive focus area for us, and we will hopefully be able to communicate a commercial launch before long. And talking about Hamburg, if you look at this slide, we have this is a visualization of a project that we're working on. And this is to give you an idea of how we envision the future product to look like. And it is a branded building. It is a way more conceptual building. It has fantastic marketing exposure with the logos and everything on the building, but it also marks a change in our general sourcing strategy. And this is a product of several things. One thing is just looking at the benefits isolated and saying, okay, if you have one entire building dedicated to this purpose, you can have some cool bars in the ground floor, or whatever that kind of supplements our brand and the things that we want to do. And you can customize the entire product to perfectly fit what you're looking for and what you want to offer your clients. And then the branding value is obviously high. There's also operational benefits. It is way more efficient to operate one full building dedicated to the purpose than having, you know, units scattered all over the place. And that's kind of one thing. The next thing is that it's one of the key learnings I would say that we've taken away from 2022. These extremely aggressive, small, stepwise unit growth month on month. It's tearing on the bottom line margins. It's tearing on the organization. It can be tricky to time your purchasing, your kind of procurement, to make your procurement efficient. So you end up spending more money on procurement than what you're happy with. So doing this transition from stepwise unit growth, where we have like 5 or 10 or whatever units coming in every month, towards these larger bulks, it's gonna be the future for us, and it's gonna mark a swap in, like, yeah, we're kind of going from adolescence to adulthood. I would say, if I have to use a more kind of lyrical term. So we have a great expectation to this. The downside is that in the short run, we will not be displaying, small increments of units coming into the portfolio. We think that we've proved throughout the year that we could add all the units we wanted. We've proved that we can cultivate relationships abroad and create international expansions. So we don't feel pressure to kind of prove ourselves anymore. So now we're focusing on making it super efficient, making it expected more profitable than what we're doing so far. And this building is a great example and testament to that strategy or sourcing adjustment. And this is a live building. This is how this potentially can look like if we can get the master lease and things like that finalized with the landlord. So we're excited about it. It's going to be different and it's going to be cool. The roadmap is the same as it's always been. So we're not changing these points, and we are facing these points as well. If we look at the one called the maintaining domestic growth, we set out to do 20% annually compounded, meaning that we should have added 60 units in 2022. We added way above that. Because we've done such an aggressive growth in 2022, we're kind of piggybacking on that a bit, taking the pressure off new units coming in, easing that pressure on everything, on the organization and so forth. And on the same time, transitioning towards doing these larger blocks. So we might not get the 72 units in 2023, but then we might in 24 we might add 120 or whatever in one go, and this is the trade-off. So I am confident that this is the future for us and this is the right way to do it going forward because of the reasons I just mentioned before. But the points is the same. The overall strategy is the same. Coming to 2022, we should still be able to, in like real nominal total numbers, we should still be where we set out to be. But we're going to do it in a bit. But the way to the end line, so to say, it's gonna be adjusted. If we then track progress compared to what we've achieved in 22, you can see that our unit growth in Denmark alone was 33%, and it was the 47 point something on group level. We did two new markets. So they're in the green. The downside is that it's been affecting some of the more bottom line fundamental value drivers. Revenue per unit is lower than we want it to be. The EBITDA margin is a bit lower than the long-term goal, which is above 15. The vacancy rates is a bit lower than where we like it to be, or sorry, a bit higher than what we like it to be, and that's again because continuously adding units. It's just they'll sit empty for a while before we can get them rented out, all that stuff. So it's kind of biting its own tail. And the return on invested capital is also lower than what we where we want it to be. That is mostly a product of the international launches because we have been forced to take so many costs directly on the P&L. So it is a transient thing, but again, it's going to be the trade-off from here on out, unless we plan for more efficient and growth in the long run, which is what we want to do now with the full houses, branded houses I just showed you. ESG has been a theme for us as well. So in parallel with developing the business and growing the business, we've also implemented a full impact report. It's available on the investors portal. From 2026 and onwards, small listed companies are expected to do this. So we figured we would get a head start and just start doing it now. So it's not as scientific as we want it to be, but it's for us a way to kind of map out our activity and identify places where we can improve. And then when it becomes a a hard requirement legislatively in 2026, we can then we are then in training, so to say. But we're doing good stuff in general. We are buying all our electricity from renewable energy sources, and it's quite a lot that we buy annually. We're doing some philanthropy work. We are big on socials and kind of diversity and etc. You can see the full impact report in our investors portal if you want to. But yeah, we're trying to give back to the community. We've launched a little informal foundation where we donate part of our revenue. We kind of cultivate our local business partners and try to support some good causes. In 22, we set out to support 2 causes, one of them being a very good private initiative called Blok, operated by, I don't know, we call it ildsjæl in Danish. She's like this is force of nature. We're set out to offset, help young people from falling into like long-term homelessness. So we're supporting them with some donations and some different stuff, donating furniture, we offer linen service to them in some different ways, and we hope to do more with them in this year. We also got involved with the Aid Ukraine network in Denmark when the war in Ukraine broke out in February. So they reached out to us, and we donated some apartments for them, so that we could take the kind of refugee pressure off a bit in general, and just contribute very humbly with what we could do. So we had some families come and stay with us for a while. We also had some people employed for a period until they decided to go back. So we're trying to do some small kind of social efforts in parallel with obviously creating value for our shareholders. So that was more or less it for me. I will close down my screen, I think.
Yeah, you can close down your screen share, because now we see your screen.
Should I do that?
Perfect.
Yes. Yeah.
Okay. Thank you very much for that, Patrick. Before I start with my own questions, I would just like to remind everyone that who's listening that you can also write questions, and I will ask them to Patrick. So I was thinking we're going to start off a bit in Sweden. And in the report it said that Sweden has had a vacancy rate of 40%. I'm guessing this is to be expected in the beginning, but I was just wondering a bit more in general of how the reception in Sweden has been, or is it still too early to say?
No, you're totally right. Yeah, it's reporting on the transparency level that we're doing. It's sometimes you don't like the data that you show, but that's part of the game, and it's the 40% it looks high, but I would say it is expected, and it's a product of before you can really get into the market and get some of the key stakeholders to notice you. It'll just take some time, and we've also had some timing issues. Before we could hire the right people, we don't want to hire before we have the apartments, because if we did that, we would then just carry the cash burn on the organization instead of having it on the stuff that has the revenue potential. So when we have the apartments, we found the director we wanted, and she had a termination notice, and it's all these little practical bits and bobs. So it's been a startup year, I would say. That being said, the reception is extremely good now, and we are more or less at capacity, I would say. Everything's more or less rented out, with the general kind of rotations that is a normal part of our business. So the client has been good to us, which we're very thankful for. And again, it's been a strong proof of concept, I would say, for us to be able to do that, and it gives us the courage to do more.
You also explained that Sweden is expected to break even or almost break even in 2023. Can this be done with existing units, or are you expecting to add more units?
This can be done with existing units.
Yeah.
But we will be adding a few in Sweden. We have we have a pipeline there that we kind of like and has committed to. But it can be done with the existing portfolio, under the assumption that demand will stay stable, or kind of as is. But it is possible with the current one.
Okay, and so as you've been explaining throughout the presentation, costs for this year have been a bit higher than usual, or this quarter maybe more specific. What can we expect going forward? I'm guessing there's been a lot of one-time costs in combination with the launch in Sweden, but also like personnel costs and stuff might have gone up a bit in price, or what can we expect going forward?
Yeah, it's a double-edged sword. I would say, inflation caught us a bit off guard last year, to be totally honest. The inflationary pressure has a direct effect on the rent levels that we pay. So they rose at a higher pace than anticipated when we did the preparations in December. In practicality, the rent levels are being adjusted throughout the Q1, and then when we saw the adjustments coming in, we tried to chase it down, throughout the year, and we haven't been able to offset it completely. The same can be said about energy prices. It's a theme in Sweden as well in Denmark. The kilowatt hour rates has just been way higher than anticipated. What we've been used to. So that has also been something, that stickiness has been something we've been trying to catch throughout the year as well. And we haven't been completely successful about it. Freight rates have been higher than normal. So the goods we get that is being shipped from our factories has been more expensive to get, than what we've been used to. The good thing is that, the energy prices looks like they're kind of back to normal. The inflation rates it's more easier for us to anticipate the future inflation rates. So that hasn't caught up off guard. Everybody's talking about inflation now. When we're doing new agreements, the bigger structural agreements that you just saw, the prospective ones with the house and everything I showed you, we are negotiating caps on inflation. Inflation hasn't been a theme for, I don't know, as long as I've been in business. So now we are, but it is a theme now. So it's something that it has way more focus than what it has had the last, I don't know, 10 or 12 years. We have been exposed to an inflationary pressure, to a cost pressure, trying to offset it. We didn't manage it completely. And then, but the good thing is that we can see that freight rates, we can see that energy prices, those sorts of things are coming down. We are not exposed to the interest rate hikes other than servicing debt. So it's not like we have any massive capital commitment that we have to service with the rise in interest rates. So I think we have seen the worst part of it, but the uncertainty will probably remain throughout the year until we get the inflation levels down to what we're used to.
Of course. Yeah. Okay. If we're talking about the revenue per unit, you previously guided, I think, 180 to 220 Danish thousand crowns per year. I'm guessing with the Swedish market, just because of the market in general and maybe currencies, that the Swedish units are cheaper. How will are you still going to be able to keep this revenue per unit, or do you think you'll see some dilution effect?
There is that's another thing, yeah. The currency fluctuations, a new theme for us. We have been exposed a bit to the currency fluctuations throughout the year. I'm confident that local Swedes, are more concerned about this, but yeah, that has been a factor. One has to keep in mind that the revenue per unit is a product of different things. Also, if the unit sizes, if you have very large apartments, nominally they have a bigger revenue potential. Bottom line, in like bottom line metrics, I would say that the spread is fairly the same if it's a big unit or a small unit. So if you look at revenue isolated, the current portfolio we have now is probably going to be in the low end of that range. And if we and kind of not guessing on where the currency fluctuations is going. On the plus side, having smaller units is easier to rent out because the nominal value is more attractive to a larger target audience, and the bottom line performance of smaller units is more efficient than large units. So it's not something that concerns us, and I would say in the law of large numbers, I think we'll be fine.
Okay, sounds good. In the last report, in your Q3 report, you mentioned that you had 25 units in Denmark in your pipeline, which you've added during the fourth quarter. You also said that these units will not be operational until the end of the year and would therefore not have a major financial impact. Has this been the case? So what I'm trying to say, can we expect some added revenues from these maybe in Q1 that haven't been reported yet?
Yeah. That should be the case. The 25 units that came in. It's also why, you know, if you add units late in the year, that will have a negative impact on your annualized kind of revenue per unit, because we take the end of the year number, and yeah, the revenue per unit number, you know, it'll always be handicapped by the pipeline that you launch late in the year. You know, because it is a naive number, so it takes the unit year end and then it divides it by revenue. So the short answer is yes, it should generate an effect in 2023, obviously, where you get the full year effect. Q1 is a bad place to do it. It's a bad time to do it because Q1 is like season in the seasonality pattern. It's always a kind of crappy quarter, but it should pick up throughout the year.
Okay, I'm gonna ask my last question now. Now I hear myself echoing when you're. Yeah, okay. Last quarter, you guided that you would stop your growth in Q1, Q2 in terms of units, and then you will start your growth strategy again. Am I right to assume that you're now gonna stop this growth strategy throughout the year and focus on your financials instead throughout all 2023?
Yes and no. If the right opportunity arises, we will act on it. But we have to stay. We will stay true to the kind of sourcing strategy. So our criteria for adding new units have been more, you know, specific, and we will be true to that. So if an opportunity arises that fits that sourcing strategy, we will act on it. If not, we will not act on it. We will only be pursuing some of the current talks we have and similar, because we wanted to kind of, it has to adhere to those criteria we've set.
Yeah. Okay, with that said, I'm out of questions. So I thank you for today, Patrick, and I'll see and hear from you in the next quarter.
Thank you so much for having this. Sorry for the ridiculous interruptions. I don't know what's going on. Let's hope that it will be more smooth next time.
Yeah, no worries. Bye.
Cool. Thank you for listening. Bye-bye.